What's up, everyone? Eric here from ES Invests, and I am back working with my good friends over at Bar Chart. And today we're going to be talking about zero DTE options. I want to walk you through some specific facts and fallacies, and then at the end of the video, I want to walk you through some best practices and things that I personally do to integrate the product into my toolkit, because there's a lot of misconceptions out there. So we're going to start with that. But before we get too far into detail, we got to start with our favorite, a good old legal disclaimer, making sure that you know I am just a random dude talking online about my experience, but I am not a financial professional and I'm not a part of Bar Chart. They are simply an organization that I enjoy collaborating with, but we are separate entities. So everything that we talk about in here is really just for general information / educational purposes only. None of this should be taken as financial advice. Okay, that aside, what are we talking about today? Facts, fallacies, and some things you should keep in mind. And one of the things I want to start with here is it's popular. Is that true? Yes or no? Is that a fact or is that a fallacy? And I will give you the answer after we look at some data. Based on this data, what do you see? So this is from a recently released paper. It's one of my favorites that I've come across lately, and it's called Retail Traders Love Zero DTE Options, but Should They? This is by Beckmeyer, Branger, and Gada, and it was published 30 March 2023. We will have a link to this in the show notes below. And this is from SSRN. This is a free information source. Spend a lot of time there because you get to learn a lot of great things, and I get a chance to kind of juxtapose this against my own data sets. And this is really useful because we get a big picture from a non-broker entity. And it's because of this little word you see up here, SLIM. You don't have to worry about that too much, but essentially there's been a price improvement protocol instituted, and it's kind of easy for us to understand from trade level details from CBOE market data who the retail traders are versus who are larger traders, aka not retail. So long story short, all of that aside, this is honing in on retail trader volume. And as you can see on this top line here, we have the total overall monthly volume and then zero DTE in orange. Notice how much orange constitutes the total volume. This means that retail is heavily engaged in zero DTE trading. Then we can see share relative to total volume from non-zero DTE to zero DTE. And then down here at the very bottom, it's just essentially zero DTE share relative to volume. The main thing to highlight here is how prevalent it's become. And if you're sitting here saying, Eric, what are you talking about, all the zero DTE stuff? We actually did a video not too long ago about this on Bar Chart. So we'll throw a link to the show notes below for that as well. That's more of a general orientation to zero DTE, what it is, what's going on with it. This video is going to be diving a bit more into detail. So hopefully you can kind of tell by the end of this one that the answer is it's a fact. This is completely true. Zero DTE has become incredibly popular. Okay, the next thing I want to talk about, it's safer than longer term timeframes. Is that a fact or is that a fallacy? And I'm going to give you, again, some information to help you arrive at your own conclusion. So what we have here is from that very same paper that I just noted before. And you can see it says cumulative daily net and gross profits of zero DTE slim options. And again, that's just us being able to identify that the retail options. And you can see the net profit and gross profit. Now, from December to March/June, the gross profit actually looked okay, meaning people were making some money. However, notice how small the net profit was, even when the gross profit was that large. You should be asking me at this point, Eric, what's the difference between gross and net in this context? And gross is exactly what you would expect. It's just the total profit. The net profit is once we take out commissions, fees, slippage. This is going to be a common theme you see throughout this entire video. There are a lot of issues with fees for retail traders eating away potential profits. And unfortunately, from about June of 22 until all the way this year, notice how awful this has gotten. So even when we have poor gross profits, once we layer on the fees and whatnot, it gets even worse still. So in this context, writ large, meaning kind of in aggregate, it is not safer than longer term timeframes. And here's kind of a benchmark to give you. This looks at the very same time frame. This is looking at just a buy and hold position in SPY for this same exact time frame from February 2021 until February 2023. Same exact thing you see down here. And notice this line right here is the $10,000 line. And that's what the starting account was in this example. And it's actually above that. So after we get dividends reinvested and whatnot, you are better off buy and hold in this scenario compared to this. Now, I want to be very clear. This does not mean that we cannot profitably trade 0 DTE options. I actually do pretty well with them when I choose to deploy them. But it is really important to know how these things perform in aggregate so that we don't have these false senses of securities or not identify an opportunity because we have bad information. So it's just important to note that if we look at this kind of in aggregate, if you bought and hold the S&P 500 for the same exact time frame that we looked at this study for 0 DTE options, it is better to buy and hold in aggregate. The other thing to note, why do we go back to February 2021? That's because that's when we started seeing these 0 DTE option cycles emerge more prevalently. Because another common fallacy here, not on this list, but worth noting, is that 0 DTE has always existed. That's not something that is novel. We've optioned, every single option comes up on expiration at some point, and then at some point it means it's 0 DTE. But the difference now when we're referring to 0 DTE options, just the immense offering, we're essentially have daily options now in things like SPX SPY. So that's the primary difference that we're referring to in this context. So is it safer than long-term timeframes? No, it's not. That doesn't mean it's not safer. It can be depending on the strategy. But when we're talking about this in a broad context, it doesn't mean that you're safer. And this is a really common fallacy because a lot of people feel that once they have no overnight risk, that it's safer than holding overnight. And unfortunately, it's kind of completely backwards. The shorter term timeframes you're trying to guess, the harder it is to have that with good efficacy. Whereas if you want to guess where the stock market is going to be in 10 years from now, it's more likely going to be higher than it is today. And that's held true essentially since the existence of the stock market here. Okay, the next one that we have, selling far out of the money options work. This is a very common argument that I hear, and it typically goes to the flavor of, well, most of the out of the money options are going to expire worthless, so this makes sense. Well, sort of. There's a little more to it than that, but the overall profitability of the strategies, selling and buying together and separately, show that retail traders consistently lose money, especially after transaction costs. I cannot emphasize that part enough because selling far out of the money options in 0 DTE, it can work, but the fees kill it. So there's an important nuance that we need to take into consideration when we do this, and I'm going to go through that in just a second. But in general, again, this is just another scenario where it's not exactly true. Okay, so I want to move into what should we do now? So now that we understand that it is popular, that shorter term timeframes aren't necessarily safer than longer term timeframes, and now that we know that even things like selling far out of the money options in aggregate don't work because of fees, how do we structure something that does work? Well, here we go. The first one is paying attention to costs. So what this means is if you are trying to buy in and out, multiple times throughout the day, capturing small movements, you are being eaten alive when it comes to cost. So it cannot be overemphasized how much we need to avoid that scenario via fees, but we also need to pay attention to the overall cost relative to volatility, which is actually kind of nice that we now have the VIX one-day indicator for people that don't calculate their own volatility, but we need to make sure that we're watching the relative cost of options because retail traders started to catch on. And you'll see once you pull up this paper for yourself that there was a period of time where we were doing a pretty good job, where if things were expensive, we switched to selling, and if things were cheap, we were switching to buying, and that tends to work okay. But the cost, not only relative to options from volatility, but also because of fees, both have to be carefully considered. The other thing here, avoid lottos. So there's a great paper by Bali, Brown, Murray, and Tang. Also, you can find that on SSRN. Just type that in. 2017 is the year of the paper. And retail traders love lottos and they don't work well. That's the long and short of it. But I know that this is super common. We see this on Reddit a lot. Wall Street Bets, super popular. And every once in a while, I get it. People have that urge to just throw some money out there, see if it sticks. But unfortunately, the lottos in the stock market are very much like the lotto tickets that you buy in real life, except the commissions are even worse. So something to keep in mind. And then the last thing here is the margins for your profitability are small. And I looked to emphasize that by making sure that the word small here was real small. And again, it's, kind of a joke, but it's also very purposeful, because if we're talking about these fees so much, I really think a lot of people don't understand how big of an impact. And I'm going to tell you right now, our findings, this is from that paper, our findings indicate that more than 60% of the 358,000 lost each day to zero DTE options comes in the form of transaction costs. So that means that if you were like a market maker, don't have costs, that a lot of people actually can make this work. And again, I've seen it. I know it's possible. But being on the retail side, having the fees that we do, it's very difficult to do so. So with all of that said, how do I go about this? It's pretty simple. The first one is sizing, leaving things room to move. You do not want to touch these things too much because the margins are small because of the costs to play. So if you put on a trade that's a 5 lot and then you're like, oh, that's too big, too small, whatever it is, and then you have to adjust it. Then you have to adjust it again. Then you have to adjust it again. You are being chewed alive in fees. Be very thoughtful of the sizing that you choose to deploy and give it some room to move around, because you have to create enough of a movement for you to be net positive after all is said and done. And we know that we're trying to get over a pretty big cost hurdle. Now, I want to be very specific on this concept of cost very quickly. When we're talking about them, people think, oh, well, my options commissions are just 50 cents per contract, so that's not so bad. Not the case. It's the bid-ask spread. You have your commissions up front, that's part of it. But then we also have the bid-ask spread. That is massive for zero DTE options relative, and that is what's chewing these people alive. So you not only trade liquid underlyings, but even if you look in liquid underlyings like SPX, SPY, so on and so forth, the fees are still so wide that you are getting eaten up. That's where this comes from. Now, another thing that I do is I really focus on volatility. I rarely trade zero DTE stuff, not never, but rarely do I trade it purely directional. It's almost always going to have a volatility component. And that's because if you're trading options, you have a volatility component. That is what makes options options, is implied volatility. So if you're trading these, you must have an opinion on volatility. Using things like an implied volatility percentile is very useful. I find that more useful than an implied volatility rank, and that's very specific because it's less prone to skew. But things like implied volatility versus historic volatility, the ratio between these two is very useful. And I actually have a video on my YouTube channel that talks about this because it's such an important concept in my opinion. You'll find it under variance risk premiums. And then the last thing, catalyst driven. This really helps us capture inflated volatility. So things like the FOMC minute releases or the rate decisions themselves or earnings plays, tying your trade volatility focused that's also against the catalyst gives you a much higher probability of finding enough room to create a successful trade, because that's the hardest part in this, again, is getting over commissions. So I hope this was informative. If there's anything that you want to see us dive into a little bit more, please throw a comment in the show notes below. And then also do not forget to like and subscribe, because Bar Chart's awesome. I really enjoy working with them. I look forward to seeing you all in the future. You can come check me out on my YouTube channel at ES Invests. And until next time, be an outlier. I'll see you guys later.